Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Matson Incorporated, ticker MATX. And this is another stock that is a ocean transportation company. And shipping services that I've looked into have been undervalued. This one's actually American, headquartered in Honolulu, Hawaii. And the whole sector just seems to be trading at a discount to fair value. They saw a nice little run up in 2022 to $100 and almost $123, and are now down in the mid 70s. They really started to take a run in mid 2020, and they didn't see a whole lot of a COVID dip. They just kind of ran for about 2 years. And now they're kind of consolidating. They have some nice support around the $60 level, lots of touch points. So if they drop, that might be a good place to trade some options. And they seem to have a lot of resistance in the low 90s. So I'd expect if they continue to run, if they flatten out, maybe see a little bit of bouncing around that zone. But they are well underneath the fair value, even with the forward analyst expectations of lower revenue, lower earnings. I'm coming up with a fair value right around the $100 mark. Well, the fair value would be right around the $128.50 mark. Our margin of safety would then be around 100, and it'd be overvalued above 142.5. That's about all that there is for the stock here. It was very flat for quite some time, and it finally saw some movement around the COVID time frame. But fundamentally, it's a very consistent company. So we can get into those numbers and see what exactly is going on there. I do have bar charts for everything for us to look into, so that way it's a whole lot easier to see, especially on mobile. So we will be looking through those. We'll just get a quick little overview here. But before I get into anything, I want to thank all you guys. I'm about to hit my first 100 subscribers. And if you are subscribed to me, thank you. Hopefully this content is helpful to you and you're getting a look at the stocks that you want to see. If you aren't subscribed, please consider it. This is the type of video that I create. You can request a stock and I'll look into it. I'll follow through the earnings for stocks that are rated to buy, maybe even a hold if there's enough demand for it. And I'm tracking everything in 3 portfolios where we can see what's rated buy, sell, and hold. And over the long term, of course, we'd expect the buys to outperform. So with that, we'll get into this stock here. We are looking at revenue in 2020 of 4.3, dropping down to 2.6, not even hitting 2.7 next year. Those are analyst expectations. The stock had been growing at 25% year over year, picking up the pace these last 2 years to 35%. So that's very good. The earnings per share growing incredibly well, moving from just shy of $2 to $27, and it's expected to drop back down to $4.50 this year. I have all of the orange over here to signify things that we look out for. So we want to see expenses as a portion of revenue declining. You know, those revenues going up and the expenses not going up proportionally. They could continue to climb, but less than the revenue, or they can be going down. And so we see that this has moved from 95% to 70% year over year. It's declining. That's a green check mark. The earnings yield, we want the current earnings yield to be higher than the return in bonds to return. That's the return that we really want to see. So 6%, way higher than 4.5%. That's good. That gets another green check mark. The share count, we want to see it declining. It's declining at a rate of 3% year over year, picking up more recently at 4.88, green check mark. The free cash flow yield, just like the earnings yield, we want to see this being a reasonable number. They got a lot of money flowing down to free cash, 12.1%. That's good. Tangible book value, we want to see it positive and growing. We see it is positive and it is growing every single year in the time frame that we're looking at. Debt to equity, we want to see this below 1 and hopefully trending down. 2.5 to 2, 1.2, 0.89. So they just this last year got into that zone. Very good at it trending down. Like to see that. That's a green check mark. ROE, we want at least 40, or we want at least 20, ideally something in the 40 to 60 range. This last year came in at 46.3, and they have potential to go higher. In 2021, it was 55.6. They are up significantly from where they started out, 10.3, 20.1. Very good. We have off of 2020's numbers, or 2022's numbers, excuse me, about $284 was a fair value, led mostly by that cash flow. They are very strong on cash flow, followed by the earnings, and then the balance sheet, and then the dividend. They're not huge on the dividend. They're good at growing it. They're growing at double digits, which we like to see, but it's only coming in at 1.67% at the moment. So it's nothing insane. It definitely sustainable off those cash flows. And our margin of safety, where we'd want to be looking at this stock, would be shy of $102 or shy of $241, and overpriced would be north of $313. But with the revenue and the earnings being dropped by analysts, we take a pretty big hit, and we drop down to $120 just about for 2023 fair value, 137.5 going forward. So we're looking in the low hundreds for the buy and the low to mid hundreds for the sell. So the fact that it's trading at 76, very reasonable. Personally, this is how I like my stocks to be, off their earnings and cash flow being the main driver of the value, because of course that's what really matters. The balance sheet is important, but if you have a whole lot on the books and you're not bringing in a whole lot, then going forward, you're just going to decline. And the dividend is pretty important to me as well. So I'd be looking at the stock around 122 based off of the projected fundamentals for this year. But now we can get into trends and see how everything's going off of these charts. So revenue and cost of goods. The revenue is the actual sales, the money, the total money that they bring in. Cost of goods is what they paid to get the product or whatever it is that they're selling. So we want to see a nice uptrend in, ideally, the blue, the revenue. Typically, the cost of goods is going to move with. If you're selling more, you're going to be paying more. But we want to see the gap widening. And that's exactly what we're seeing here. 2019, it was kind of small. Both of the bars were pretty small. And every single year, it's been growing. There's a huge gap expected for this year, but we'll see how all that pans out. And then we have gross profit, net profit, and EBIT down here, where gross profit is just your revenue minus your cost of goods. The net profit, you subtract out all your other expenses, and then the EBIT, the interest and tax and everything plays a role in there. So we see that the gross and net are staying pretty consistently correlated. Well, actually, all three of these have been pretty consistently correlated. So they're holding their margins pretty well. And we can go back to the numbers and see that they had a gross margin of 35%, a net margin of 24%. And let's see, they started out, so they've been killing it, moving up from 3.8 on the net and 14.8 on the gross every single year, improving their margins. And that's exactly what we want to see in a company. We can move on to the balance sheet, and we can see that this is their assets. We have their assets and their tangible assets. So what portion of that could, if they needed to, they could liquidate it's got a set value, they could access it. And we want to see growth. And that's exactly what we're seeing here is a nice growth trend in both the tangible and the intangible assets. Liabilities and the tangible book value. So that tangible book value would essentially be the tangible assets minus the liabilities. And we're seeing flat liabilities. It's not going up or down really. It's just hovering around that 2,000 mark. These numbers are in millions. And the tangible book value is on a nice uptrend. So that's shown by our tangible assets up here are growing very nicely, but our liabilities are staying very flat. So that's exactly what we want to see. Cash flows, we want to see positive cash flows, and we want to see growing cash flows. So in 2019, cash flow was negative, and they've grown it very consistently through 2022. Of course, it's taking a hit because the revenue is taking a hit this year, and they're back to about 2020 levels. And then there wouldn't be a whole lot of growth into that because there's not a whole lot of growth in the revenue going forward. So, I mean, we'd hope that the analysts are wrong in their projections for this stock. We'll see as the year goes on. And maybe in the future, we'll start to do our own projections for stocks and see how we shake up against the analysts, especially for stocks that have very few. And then dividends. We want to see a growing dividend. And that's exactly what we see here. Just year over year, they're growing that thing very consistently. So what I see here for the company is it is incredibly consistent. It meets all of the criteria, and it is fair valued. So I'm leaning towards giving it a buy. Even with the cuts projected from analysts, it's still at a good value. The 2020 drop in the stock price was warranted, but the stock had never even caught up to its fair value in the first place. So it's going to be a little bit of sideways, most likely, and then it's going to, over time, reach its value. We see the share price has grown rather consistently and quickly. It was up 40% in 2019, 57% in 2020. It was down 29% in 2021. And so far, it's up $13 over the course of the last 6 months. So it's definitely on that uptrend. It's a stock on my radar. I'm leaning towards a buy. I would definitely buy this over Zim or some of the other companies that I've looked at. But hopefully that answers any questions that you've had. And it gives you an idea of what to look at for stocks in general and this stock. I want to thank you guys for watching, especially if you made it this far. Let me know if there's any other stocks you want me to look at down in the comments. I have a few on my list that I got to get to still. I'm working through them. It takes quite a bit of research to do all of this. And if you learn something, if you own this stock, like the video. Let me know, get a gauge of what you guys think. And please subscribe so that you can see more of this content. I'm trying to bring it to you guys every single day. And I will catch you next time.